With fears of inflation on the rise, the stock market just ended its worst week since October. But the worst may be yet to come. Economist Mark Zandi warns that investors haven't fully grasped that inflation is dead ahead. He goes on to say that inflationary pressures will develop very quickly, and he doesn't believe there will be any shelter. We might start asking ourselves, is the market facing a minor blip in the road? Or is this the point when the whole thing comes crashing down? Some argue that this, right now, is the end of something known as the long-term debt cycle, and that we are on the precipice of the worst economic recession in history, which will feature, as the main attraction, a market crash of colossal proportions. But is this really the fate we are faced with? We're going to talk about that and try to understand what is really going on. And most importantly, we are going to cover what all this craziness means for you and 5 things that you should be doing right now no matter what the future holds. But first, it's my privilege to offer you a chance to make a significant impact today. By clicking the like button, you make a big difference. So please give it a click. Let's get into it.
Subscribe.
The economy at its core is made up of transactions. Money, or credit, is exchanged for goods and services. All of these transactions combined make up the economy. Also, the economy has cycles. There's a period of economic expansion known as the boom, or bull market, followed by an economic retraction, the bust, or bear market. All of this is known as the business cycle, or more accurately, the debt cycle. I call it the debt cycle because it is credit that drives the ups and downs of this cycle. Remember, credit and debt are 2 sides of the same coin. Specifically, I'm saying that whenever you have credit, you have cycles. It's an intrinsic property of debt in any economy. Credit allows people and businesses to buy things they cannot afford with money they do not have. When money is loaned out, the lender has an asset and the borrower has a liability, debt. This debt causes the debt cycle because it allows people to spend a lot now, but later when they have to repay the debt, they will be forced to spend less. For example, since the economy is made up of transactions, during periods of high debt where people are spending a lot of borrowed money and making a lot of transactions, sellers of goods and services can sell more goods and more services, which allows them to hire more people, which allows those people to spend more money, which drives up prices. And as people get more money, they are more creditworthy, which allows them to borrow more until eventually people have so much debt that it makes sense to slow down and start repaying the debt, which causes businesses to sell less goods and services, which means they cannot afford to have as many employees, which means there are less people working, and more folks who have to cut back on their spending. This is how the short-term debt cycle works. These cycles last somewhere between 5 and 7 years. And you should know the Federal Reserve works to not allow these debt cycles to get out of hand. When the economy is heating up too fast, the Federal Reserve will try to slow things down, and when the economy is starting to stall out, the Federal Reserve will try to fire it back up again. They use monetary policy. For example, they can lower the federal funds discount rate. This makes it less expensive for banks to borrow money, and thus encourages banks to lend. And when you have more lending, you have more debt, and you expand the economy. Another Federal Reserve tool is something called open market operations, where they can manipulate the supply of federal treasury bonds by buying them up and thus driving down the bond yield. This works because if there is a high demand for bonds and a low supply for bonds, the yield doesn't need to be high to attract more buyers of bonds. This is actually what spooked the market recently, because the bond yield has been going up, and expectations were that the Federal Reserve would suppress the rising bond yields with additional open market operations. But good old Jay Powell did not announce that the Federal Reserve would take such actions. The market read into that as meaning the Fed believes that inflation is about to come. This is because bond yields rise when investors expect inflation. Think of it, inflation erodes the purchasing power of any bond's future cash flow. Thus, investors demand a higher yield to offset this risk. Which, by the way, on a year-over-year basis, inflation may in fact appear to go up a lot, because during the illness, inflation reached a low point. So compared to that, even a normal amount of inflation will appear larger than expected. I think this is why the Fed has decided to target a long-term average of 2% as opposed to just 2%. I believe they expect a big boost to inflation followed by another period of lower inflation. And as long as it all averages out to 2%, we're good. But I digress. Let's get back to the debt cycle. Here we see the short-term debt cycle. Some believe that if we zoom out, there is a larger long-term debt cycle that happens maybe once in a lifetime or about every 50 to 75 years. This is a much bigger event that leads to enormous economic despair. A massive deleveraging takes place, and the entire fortunes of many are wiped out and may never recover. Some signs that we are close to the end of the long-term debt cycle could be that the Federal Reserve has used up all of their leverage. Because after pushing rates to zero, there isn't much more they could do in this regard. Also, the growing wealth gap between the rich and poor and social unrest are among many other factors that could indicate that our economy could be running near the end. Alright, whether you choose to believe in a long-term debt cycle or not, it's up to you. But one thing you might have noticed is that none of this explains how we have any real long-term growth in the economy. What I mean is, how do we go from this to this? Because the economy always grows, but how? The explanation for this is productivity. Productivity is easy to understand. Think of it. Suppose you have two friends and one mostly sits around watching TV and isn't very productive, and the other is always busy working hard to provide value to society. Now, assuming their habits don't change, and you were able to travel 10 years into the future and check up on both of these friends, who do you suppose would have achieved the most success? The answer is obvious. Most likely the most productive friend would have been the most rewarded by society. And productivity works the same way in the economy. It's increases in productivity that drive the market upwards. Now, you ready for this? There are three inputs into the economy that can drive productivity: more labor, more capital, or technology. And guess what? Two of these inputs have a limitation known as diminishing returns. Suppose there's a restaurant and you have one chef working in the kitchen. The chef can only produce so many meals. If the restaurant wanted to increase productivity, they might increase labor by adding a second chef, which, by the way, this will obviously cost more capital also. So two different inputs have been increased. Well, good news, this will probably work. The restaurant will be more productive and produce more plates of food more quickly. However, if they add a third chef, that third chef will not be able to produce as much as adding the second chef did. This is called diminishing returns. And this happens because the chefs will be fighting for resources, such as the oven, the pots and pans, etc. And if they continue to add even more chefs, we could end up literally having too many chefs in the kitchen. Makes sense. I mean, you get it. You can't just pack a bunch of chefs into a kitchen like sardines in a can and expect that each one will be more productive. But technology and innovation, however, can make any chef more productive without the need to add another chef. For example, a robot that does all the prep work efficiently and quickly. Technology works in this way across the entire economy, not just restaurants. So what I'm saying is that technology is the key to keeping productivity growing so we can maintain this and not get this, or even worse, end up with this. Okay, let's talk about what all of this means for you and what you can do to make sure that you can prosper no matter what happens in the economy. Of course, this might be a good time to say, I'm just a guy on YouTube, and this is purely for entertainment, so do your own due diligence. Alright, firstly, let's start with the market dropping over the last couple of weeks. We hear all sorts of stuff about this, like, it's only a minor correction and the market is spooked over inflation. Or, the market is simply flipping out of overvalued tech stocks and into recovery stocks. Others say we have reached the end of the long-term debt cycle and we are now faced with certain economic doom. I say either way, it doesn't matter. The important thing is to have sound investment strategies that you can stick to long-term regardless of what the market is doing. My personal prediction is that the market has more expansion to do before we see the next major recession. I don't foresee a larger scale housing and market crash starting until at least somewhere around 2023. But certainly I have no crystal ball. What do I know? However, there are some things you should be doing right now that will benefit you regardless of the direction the economy is about to go. And don't worry, I'm going to talk about exactly what I think makes sense to buy in the stock market right now. But even before you go and invest in the market, there are a few boxes that you should check. Number one, this is a good time to diversify your income streams. Unless you've already reached your desired level of financial freedom, if you have a job, keep it. Try to elevate your position and get yourself a raise. Also, in addition to a job, consider starting a side hustle of some sort. Try to find one that can pay you passive income. It's always best to earn money for the value you provide versus trading your time for money. This topic alone can be a whole video, but the point here is to have income coming in through several different streams. This way, if one stream fails, you have a backup. Number two, you should pay down any high interest debt that you have outstanding. And start with the debt that has the highest interest rate. For example, payday loans or credit card debt. Those will eat you alive. It's important to pay those to zero like yesterday. And don't be a sucker. If the economy were to explode, you don't want to be left holding the bag. 3. Any real estate that you plan to buy, make sure you have as much of a down payment as possible. I recommend at least 20% down. And if you're going to do cash out refinances with existing properties, leave at least 20% equity in the property. 4. Now when it comes to investing in the market, the most important thing is if you already have your money invested in great companies, don't panic. Running off and selling everything after a few red days is the worst thing you can do. Believe me, I know how hard it is to see your money just drop and then drop and then drop some more, and when you think it's all over, it drops even more. But I assure you, as soon as you sell off and lock in those losses, that is the day that the market will have a massive recovery. And you're gonna be upset that you sold. Instead of selling, consider buying more. You can average into your positions to lower your cost basis. After all, you believed in the stock at the higher prices. So if it's still a good stock, buying more of it at a discounted price will just set you up for more profit whenever the market rebounds. As far as this whole discussion goes about people shifting away from tech and tech is over, blah blah blah, I have to say, I still believe in Apple, Etsy, Amazon, etc. Remember, as we discussed earlier, technology is key to continue to drive productivity. This means illness or not, I believe these companies are going to continue to be positioned to drive the economy forward, and they will do well in the long run. All right, the last bit of advice I have for you is to diversify your holdings. Buying an ETF that tracks the S&P 500 or total stock market, for example, is a great low-cost way to easily diversify and minimize your risk. Buying VTI, for example, gives you ownership of 3,576 different companies. If one company or even one sector flips, you're still invested in all the others. Now I get it, VTI isn't a sexy or particularly thrilling way to invest in the stock market, but in this case, I say boring is best. And you'll have the confidence of knowing that the long-term trend is always up. You simply have to diamond hand hold VTI. All right, and as a bonus tip, speaking of diversity, if you really want to diversify, maybe consider putting 3 to 5% of your portfolio into Bitcoin or Ethereum. However, only put into crypto what you're not afraid to lose. But buying a little bit of crypto could be a good hedge against a fiat currency that is being devalued with every dollar they print. If you found this useful, consider subscribing to the channel, and don't forget to hit that like button. Until next time, you guys are awesome.